Well, it's good to see everybody, and it has been a challenging couple weeks in the market and really a challenging year. So, I want to talk about some key points and some things to think about. So, number one, let's talk about the stock market and where it's at. So, if you look at the stock market and you divide it up into different sectors, so tech stocks, financials, retail, and there's several others, but I'll focus on those big three. So tech stocks are well into a bear market, and these are companies that tended to lead the way out of the COVID market, which bottomed March 23rd, 2020, and then just sort of skyrocketed from there. And tech stocks were your leader. And the way tech stocks tend to work is they tend to be very, very volatile. They tend to lead during good times, they tend to lead during bad times. And that's certainly been no different. And so if you look at the NASDAQ as an index, which is probably your greatest indicator of tech stocks, it's well into bear market territory on the year. And then you compare that to like financials, which have sort of not quite into bear market territory. But I think let's focus specifically on some major retail, Target and Walmart this week. So both companies reported earnings this week, and I think Kohl's is soon to follow. And both missed their earnings. Both came out and said inflation is starting to hit us hard, and we're going to have to grapple with that as a company. Now, Target made it pretty clear that they didn't intend to raise prices yet. They were going to just try and eat into their profit as inflation has risen. In other words, their expectation is a short-term impact to the company's financials, and they really don't want to pass that on to the consumer just yet. But with that report that earnings are slowing, it's pretty clear that inflation has in fact impacted America, and hopefully that may be an indication that what the Fed is doing with interest rates and their monetary policy might actually be working. We would expect, I think anybody would expect, for inflation to be under control. There would be some point in which retail, in which consumer spending would have to slow. It's the very definition of reducing demand. So I don't think what we've seen this week was too far unexpected. Certainly it created a lot of market volatility, and Target, for instance, was down 25% in one day. Still, they're making money. They still have a positive earnings per share, down 25%. So the inefficiencies in the market that get created during growth cycles always wind themselves out during bear cycles. Cycles where the market is going down. So in the short term, that's what makes it so difficult to be a short-term investor, to try and make short-term money on the stock market because of the inefficiencies. Long term, though, that efficiency tends to work itself out. You don't have to think back very far. You think back to COVID when the market was down 31% over a 1 month period, and the panic and the fear that was being created by the falling stock market. Now, it was so fast that a lot of people didn't even take the time to digest it before the market had come back. But if you go back to 08 and 09, when it took a year and a half from peak to trough to decline 57% in the general market, the fear was the same. It was quite frightening. And in that case, the reasons were different. But in all cases, during these bear markets, at some point, the market finds some stable footing. At some point, investors, the sentiment changes, and suddenly there's more buyers and sellers in the market. And then long term, those efficiencies are regained, and the market tends to recover. And long-term focused investors who didn't panic, who stayed the course, tend to win the game. So our process and the way we manage and design retirement income plans is designed just around that. Making sure that you have the time horizon to endure these difficult markets. Making sure that when stocks go down, and it's not a matter of if, it is when, because markets cycle, when they go down like they have this year, that there's not a forced sell. But the only reason you would have to sell would be to change the investment strategy because out of fear or worry or some other reason. But that's the only reason you would be forced to sell. You're not selling stock as the market's going down, which allows you to stay focused as a long-term investor and recover when the markets eventually do recover. Now, the problem is we don't know when, right? That's the very difficult part, is timing the market is next to impossible. At some point, we'll find a bottom. Now, we won't know on that day that it's the bottom. It's impossible. There's a lot of articles out there you can read that say that, look for the days with the maximum fear, or look for X, Y, and Z, and that tends to be the bottom. The truth is that's almost impossible to figure out. But what we do know is we don't have to. If we think long term and stay focused on the long term and manage our emotions as best as possible during these difficult times, you don't have to pick the market bottom, you don't have to pick the market peak. You basically just ride the wave. So while we certainly can't calm down the intraday volatility in the market, we certainly hope that if we stay focused on the long term, it can calm some of the fears that we're all experiencing. I hope everybody has a great week. As always, if you have questions or concerns, give us a call. Let's stay focused on the long term. Take care.